Did you see the CPI print on Tuesday? Let me tell you, your price at the pumps may be going down. That helps people feel better, but there is so much going on underneath the surface. Coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer, really specializing in custom strategies. And as you can see, yay, we are back in the home studio again. And I hope you like the changes that we made. But I don't think you're really going to like the changes that I'm going to show you today. Because frankly, when you hear the Federal Reserve talk about a soft landing, I suppose it really means for depending upon who you're talking about. And they're also dependent upon something that has never, ever been accomplished before. But of course, we have seen so many good things from Fed Chair Powell. I mean, he's just been so spot on about inflation and everything else, and I hope you realize I'm being completely facetious, that he can certainly now engineer a soft landing by having those that have been out of the workforce come back in and those that are in the workforce remain there. It's quite interesting. This has never happened historically, but hey, I'm sure he can pull this off because he is depending upon this. Well, that's not going to happen as he's raising rates and corporate profits come into question. I don't know, maybe I'm wrong. I mean, that's certainly something beyond my control. But his main focus is and has been restoring price stability. Remember, 9 times in that last speech, will likely require maintaining a restrictive policy stance, which means high interest rates for some time. But price stability is not about the price of goods and services remaining the same. It's the price that workers get paid, so you're not asking for more money. So he needs more people to come into the labor force to it. But it hasn't happened yet. Quite honestly, the U.S. labor force has not yet normalized, though some people that, perhaps this is just my speculation, may or may not be true, but some people that were meme millionaires, crypto millionaires, inside of what's been happening in both of those markets, they could indeed be coming back onto the job markets. Policymakers may feel that they have to bring labor demand down further if they don't see labor supply increasing. Hence, not a soft landing. They can't do it. I mean, the expertise that they've shown. But let's take a look at what that labor force participation rate really looks like, because you can see that it peaked in the 90s. Interestingly enough, that's also the peak of when debt was no longer actually stimulating to the economy. I think that's a kind of interesting coincidence, maybe. But you can see that they were getting it to lift up a little bit more. And then, surprisingly, the pandemic hit. This is the same graph, but just kind of focused in that particular area. And overall, what you see is that the labor participation rate is far below what it was before that pandemic hit. So it really was just continuing the trend that had really started back in the 90s. Shocker. It's as a system ages, things change quite a bit. But the key labor force participation rate that they're really wanting to go back is that area between 25 and 54. This is the prime rate. And it has certainly jumped. You can see that, which again, I mean, It could certainly be those that were millionaires just a few months ago that are no longer millionaires because the market stopped cooperating with them. That is pulling them back into the market, because you can see here's the top, here's a pretty big jump. So we're just going to have to wait and see what really happens. But hopefully the prime age workers are now coming back. And I don't know, after today's CPI print, where, yeah, oil was down, but services have exploded in terms of inflationary pricing. Yeah, we got a problem. And part of that is the threat to those that are currently in power. And that's really what the battle is. When you take away all the other stuff, they want to remain in power. The Fed wants to remain in power. The government wants to remain in power. And when people get hungry and hopeless, yeah, those things have a tendency to change. But growing inequalities reflecting growing employer power. Now, I'd like you to take a note on the date of this, which is 9/2/21. So pretty close to 1 year ago. Growing inequalities reflecting growing employer power have generated a productivity pay gap since 1979. Shocker, we've talked about this many times before. But while productivity has grown 3.5 times as much as pay for the typical worker, this is what that looks like. I mean, frankly, you've got the average pay up 144%. You've got productivity up 253%. And where has all that excess productivity in terms of pay gone? It's gone right to the top. You can see that we've kind of hit a level here, but this is really when it becomes problematic, because it's so obvious, especially in light of the rapid inflation these days. Those at the bottom, they're demanding more money. And Fed's Chair Powell's, nope, we're going to stop that puppy. We're going to stop that right now because we need price stability. Yeah, how about some price stability up here? What do you think? The average income declined when adjusted for inflation. Really? Yes, really. It's that nominal confusion. We get so tied up in the numbers that we don't really look at that purchasing power loss. That's how they get you. Hey, average wage in 1971, $9,500. Now, like 56, 58,000, something like that. Well, you'd say, well, I'd much rather have 58,000 than 9,500, except that 9,500 bought so much more, like 95, 98% more than it actually does today. So a family of four could live on 9,500. Can a family of four live on 58,000? Yeah, under a bridge maybe. I mean, it's a really very sad state of affairs. But there have been two studies that just came out recently, and I'm going to be talking, I did just talk about those on Tuesday. But one study warns that Fed Chair Jerome Powell and his colleagues will probably have to push unemployment significantly higher in order to hit their 2% inflation target. And what they've been talking about is 5% for 5 years. Well, that means that even those people that are coming back in, you still don't want the hiring to be going on, because that's when they have a claim to more money. A second study warns of dangers for developing nations due to rising U.S. interest rates and a strengthening dollar, and it's those rising U.S. interest rates that makes the dollar stronger relative to those other countries. And we've talked about this quite a bit before, because so many of those emerging market countries, including China, has taken out a tremendous amount of debt in terms of dollars, but they don't earn dollars. We earn dollars here in the U.S. So that makes that debt harder and harder and harder to service. Now, I love this. This is out of one of those studies, but inflation is, this is out of Brookings, but inflation unlikely to reach the target by the end of 2024. My God, they can't even go month to month. So they're going to project out a couple of years and expect that that's where we're going to be. It's garbage. It's all about misdirection and them wanting to feel like wanting you to feel like they have control of inflation. They don't have control of it. Let's face it, that's why you got to have this, and that's why you got to have this, because they don't have control. And if you trust them to have control, heaven help you. I mean, I don't know what to say about it, but heaven help you. But this is like so important. We've talked about it so many other times, and that's the real strength. Surging inflation adjusted U.S. yields help drive dollar dominance. Why? Because this is the theory, and it works until it doesn't work. I'm just being honest about this. That when the Fed raises interest rates, it attracts more investors in the dollar because of a higher yield. Oh, woohoo. What they miss, what everybody seems to miss. I mean, it's really interesting. I talked to some really, really, really smart guys, people that I admire like so much. But what they never talk about, even when I bring it up, they kind of sidestep it. It's so interesting that this is the end of the currency's life cycle. So what if the stock market goes to 5 trillion? 5 trillion times zero is still zero. Nobody talks about the death of the dollar, but they'll talk about how strong it is relative to other currencies. That's garbage. Because what really matters to you and me, now look, if you're traveling, okay, you got a little advantage, except everybody globally is inflating away their currency. You cannot inflate this away. You can inflate away a currency because you push a button and you can create trillions and trillions and trillions and trillions and quadrillions of dollars. But there's a finite amount of gold and of silver. There's a finite amount of it. And both of these elements are used in every single sector of the global economy. So there's always demand. That is critical. Dollars are only used in one area. Trade, barter, things like that. So when that demand goes away, what happens? That's why it's so critical for the central banks to maintain that level of confidence. Can you see how correlated the interest rates and the dollar strength relative to other currencies, not relative to purchasing power? Can you see how correlated they are? And then what happens? They raise the rates and you see the contract spot markets react to that. That's Wall Street. Do you trust them? If you do, I really have a really good shrinky dink that you should probably start seeing. Because how many times can you be lied to when you do not know the truth? But I'm trying to show you the truth out of the horse's mouth, not out of my mouth. Don't take my word for it. But don't take anyone else's word for it either. Do your own due diligence. That will serve you much better. Follow the links. Just go to the blog. You'll see my writing. You'll see all the links. You make your own conclusions. But this is what reality is. Surging inflation adjusted U.S. yields help drive dollar dominance. That is such garbage to you and me. To Wall Street, maybe not garbage until it really is garbage and all confidence is lost and we're in hyperinflation. Doesn't really matter how many dollars you have. In Zimbabwe, there are billionaires and trillionaires and they can't buy eggs. Fed inflation battle to spur greater economic harm than realized. Big old shocker. Of course, they're already instilling so much more harm. You saw when we peaked. Danger signals are flashing already. A contradictory phase of the global financial cycle is now underway. Do you see what they're admitting to here? What I keep trying to tell you, what I've told you for years and years and years, and yes, I am redundant. Because this isn't just like a one-off incident. This is a constant and compelling issue that has happened for you personally since the day you were born. You were born into this lie. You were fed this lie your entire life. It's hard to have a paradigm change. You don't want to think that you've been lied to your entire life and that all of what you believed is garbage. But I remember being a stockbroker in the 80s, and all they were talking about was how fabulous globalization would be. And I remember thinking to myself, yeah, I can see that this might not be the best thing in the world. So we had that globalization from the 70s and 80s until the 2020s, and now we're in a phase of deglobalization. Yes, the system that they built since the 80s, 70s, and 80s is clearly, going away. No doubt about that. But I can't sit here and tell you that there is not a new form of globalization or a transition to a new globalization control that's occurring. We're going to find out as time goes on, and I really kind of hope that I'm wrong, but I really kind of think I'm not. But I hope I am. I'm going to say that. Because even the central banks are telling us, Lyle Brainerd, is saying risks will become more two-sided at some point, which means they're damned if they do and they're damned if they don't. And what position do you want to be in when we get to that two-sided, the risks two-sided at some point? And are we pretty much there right now? I mean, Fed will fight inflation as long as it takes. They created it. They don't ever say what we did, we're trying to fix. There are always unintended consequences. They do one thing, that leads to something else. And that might well be a depression. Recession or depression. I mean, what is a depression? It's just a deeper form of recession. And there's only one way to fight inflation, and that's with deflation. So how do you fight hyperinflation? Depression. The number of Americans taking out loans just to buy groceries has doubled this year. Oh my God, just to buy groceries. Those buy now, pay later, BNPL, they have been cropping up and they've been doing really, really well. And these are the most common uses of buy now, pay later. Clothing, electronics, furniture, appliances, housewares, cosmetics, food and drink, entertainment, exercise, sports equipment, accessories, and jewelry. So many unnecessary things other than food and drink. Well, food anyway. But do you know what all of this new debt is on buy now, pay later? It's non-self-liquidating debt. So what that means is that whoever takes out this debt has to go to work, generate money to pay that debt. Self-liquidating debt is I take out a loan to expand my business, I get in more customers, and that business repays that debt. That's self-liquidating debt. This is all non-self-liquidating debt. And anybody that has run a yard sale knows that you may pay $50 for this blouse and you're lucky to get 50 cents when you sell it in a yard sale. Non-self-liquidating debt. That saddles those that can least afford it. Zip says, so that's a company that does this for Costco, DoorDash, Safeway, Starbucks, and more. Business is up 95% this year for people buying groceries, while restaurant bills are up a whopping 64%. I'm thinking it's probably more expensive to go to a restaurant than it is to buy groceries and cook at home. But do you see what's really happening in here? 95% for people buying groceries. 95%. Food becomes the single biggest issue during these transitions. Therefore, the mantra, food, water, energy, security, barterability, wealth preservation, community, and shelter. This is what we need to retain a reasonable standard of living. But if you take on debt to maintain a standard going out, I mean, my God, you're going out to eat. You eat once and you have to pay for it every week for the next 4 weeks or the next 6 weeks or 8 weeks or however. That is mind-boggling that anybody would make that choice. And now you could argue, well, if we put that on a credit card and we don't pay off the whole thing every month, we're doing the same thing, and maybe that drags it out. But do you realize how much more that ends up costing you? Because that's not smart either. You should not take on debt that you cannot afford. But the government has huge. And who really pays for all of that? They're spending your money. You okay with that? It's up to you. Because if you have to break down your food every week in 4 monthly payments or 6 or however, whatever the terms are, and you miss a payment, well, of course, why would you miss a payment? I mean, it breaks it down into itty bitty pieces, but if you do it a lot, a full third of all buy now, pay later users end up falling behind on at least one payment because they couldn't afford it to begin with. Nearly 75%, or roughly 3 in 4 users also end up taking a hit to their credit score, which makes it harder for them to take on even more debt, like, oh, I don't know, buy a house. But hey, maybe it'll be forgiven. Many service providers charge late fees, meaning a simple purchase can quickly become expensive if payments are not made on time. Shocker. A report from Fitch Ratings also shows that the average buy now, pay later user already has higher than normal debt, suggesting that indiscriminate spenders are the target market. Of course they are. And I hope you don't fall into this category. And if you have, stop it, because it will not serve you well. Well, I'm sorry, I shouldn't say that, because you actually get to do anything you want. I'm not your mother, and I'm not your grandmother. But I so strongly discourage you from doing this and falling into the trap. And you know, I'm not going to sit here and tell you that I was never inside of that trap. Before I really became a stockbroker, especially, you know, like most other people, hey, if I want it, you know, we've been trained to not have patience. You want something, you go out and get it now, you'll pay for it later. Well, you will pay for it later, but I'm just not sure that it's what you were originally thinking. Because the bottom line and the truth is this will not end well for most. But you definitely do have a choice. Now, I want you to think about this. This is Q2 2022 coin and bar buying. So this is the retail public. And the dark green is Europe, right? This area is Europe, and this is the US. So what we can see clearly without any lines or anything is that Europe has definitely been buying a lot more bars and coins. Now, Europe is just a bit ahead of us in terms of crisis, right? Something to think about. But what I also want you to look at is that the U.S. buyers, I drew a line so you could actually see it, near the highest levels of 2016, the only two areas that were higher was the first quarter of 2022 and the first quarter of 2021, just a teeny bit. So somebody out there in the U.S. is getting the message, and they're going in the right direction toward gold so that it maintains your purchasing power and protects you. So I'd say you're in the right church. I'm just not sure you're in the right pew. You might want to do a little bit more research on that. That is, however, up to you. Personally, I don't buy any new stuff, any new gold. Silver, yes, but gold, no. Because if they've been robbing you your entire life, do you really think they're going to stop at the very last minute and say, no, we want to protect you? I don't think so. Maybe I'm wrong. So I buy the kind of gold that doesn't really matter if I'm right, if I'm wrong. And everybody knows that. That's not something that I hide. But I do have to ask this question. Do you think that Europeans see something that we Americans don't? And we're going to be talking to our friend Jeff in Bulgaria pretty soon to get an update on what's going on, particularly in the energy markets and the limitations and what's really happening over there on an economic level. And I think that we need to pay attention because they're just a little bit ahead of us. And so it actually is a warning. And as you can see, Edgar, can you go back to that graph? As you can see, they have been accumulating a lot more gold than the Americans. And that's because they are closer to crisis. Although I don't know that that's necessarily so. I mean, Black Swan event is something that comes out of the blue that nobody anticipates, nobody sees. There are so many swans that are flying. Which black one is going to land? I can't tell you. But I know that I'm more comfortable being really ready. And I will also tell you, I'm very excited because not only do I have my home studio back again, but we also have goats. And we're going to talk more about that on our new BGS, Beyond Gold and Silver channel, where I do talk to you about all the different mantra pieces and show you what we're doing here, and also try and create a library that gives you access to wherever you are. If you're an absolute newbie, okay, we're going to help you get started. If you're an expert, we're going to take you to the next level, or come and join us and help others get started. That's the community that we're trying to build, Beyond Gold and Silver. And there's a website as well as a YouTube channel. So now remember, if you haven't done this yet, you got to watch Tuesday's video on the 2 new IMF reports that just came out. One in particular, they tell you what the game plan is, and it is an absolute setup to hyperinflation. I am not kidding you. You want to see what this is. So if you haven't already watched Tuesday's video, do so. Do yourself a favor and share. And remember that you can also listen to us anywhere, anytime on all major podcast platforms. And I think we're even going to be expanding that into something else. And I'll tell you about that as we go along. But, honestly, if you haven't already set up your strategy, do yourself a favor. Get that strategy in place and get to executing it as quickly as you can. And a good way to start is by clicking that Calendly link below and giving us a call and setting up a time to meet with one of our consultants that can help develop your own personal custom strategy so that you can walk through this mess with confidence. And the sooner you start, the better off you're going to be. And if you haven't already, please subscribe, leave us a comment, give us a thumbs up, and share. And until next we meet, please be safe out there. Bye-bye.